Welcome back, everyone. Today on the Joseph Carlson Show, we're going to be looking at 20 of the most popular stocks in the market. These are many of the ones that are passed around social media, many of them that are in my portfolio and your portfolio, and we'll be determining the valuation of these companies. We'll be looking at a tier ranking list here, ranking them by undervalued, fair valued, overvalued, or whether or not they're a sell, whether or not we should just get rid of them entirely. For each company, we'll be looking at a few of the fundamentals of it, trying to go over qualitatively what's going on, and we'll be using the Qualtrim discounted cash flow calculator to run some assumptions to try to determine how things will look in 5 years, and therefore know what to pay for the company today. And from that, we can more accurately place these companies where they belong and identify the best opportunities to invest in now. So here we go, 20 of the most popular stocks in the market, their valuations. Let's start off with Google. Google's currently trading at $171. It's moved up around 3 or 4% over the past couple of months. The PE ratio of the company is trading at a 19-4 PE ratio. Based on 2026 earnings per share estimates, it's at a 17. The free cash flow before stock-based comp is factored in is 3.6. Once you factor in stock-based comp, it's 2.5. Now, that's better than most big tech companies. It trades at a much lower PE ratio and even a higher free cash flow yield. When we look at Google, there's a couple things that have been happening with this company. First of all, it made some news that Google, in terms of net income, if you just look at the pure net income of a company, it's the most profitable company in the world. So Google's actually generating the most net income under a trailing 12 months basis of any stock in the world. More than Apple, more than Nvidia. It's done $111 billion in net income over the past 12 months. Go ahead and compare that to any other stock. So even though Google's not the biggest company in the world by market cap, it's producing the highest amount of net income. A couple other valuation metrics we can look at is the historical value of the company. If you look at the PE ratio over time, this is a very simple equation. Lower equals cheaper. It is cheaper today than it was in 2024. If you go back 5 years, it's about the cheapest it's been over the past 5 years. Free cash flow yield differs in that the higher it is, the cheaper it is. So the more that this graph goes up, the cheaper the company's becoming. And it shows about the same thing. September of 2022, it had the highest free cash flow yield, and that was the best time to be buying it. Now, it's not quite as cheap as it was back then on a free cash flow basis because they're doing massive CapEx investments into their infrastructure, into cloud, growing Google Cloud. So it's not quite the same price in free cash flow, but it still shows a similar trend. Google today is at a much cheaper valuation on earnings or free cash flow than it really has been over the past 5 years. Why is Google so cheap? Because of commentary around ChatGPT growing quickly. Now, there's various reports on this. Lots of people are actually suggesting that Google's growing a little bit faster, or there's some months where Gemini's growing faster. Google has a massive marketing budget, so they're doing a lot of advertisements about Gemini. So they're getting a lot of adoption for Gemini. And even outside of growing the Gemini app, Google has Google Search, there's AI overviews, there's Smart Mode, there's Google Lens, there's the integration into Samsung phones, and so on and so forth. So Google's growing their search business in all different ways. Now, if we look at the other segments, we have YouTube ads. YouTube, I believe, is an incredible crown jewel of an asset. There's really nothing like it. I like Netflix a lot, and I like YouTube. I think they're the two best streaming scaled entertainment companies. We have Google Network. This isn't going anywhere, highly profitable. We have the subscription portion of the business, which is like the Google One, all their subscriptions. I believe that even includes the YouTube Premium subscription. So that's growing quickly. We have Google Cloud, which is just an incredible business. I like all three cloud businesses. I like Azure, I like AWS, and I like Google Cloud. It's growing 30% year over year. It's massive, and the margins are moving up. And then another one that I don't want to forget about is other bets, which includes Waymo. We have this charted out right here. This is in Qualtrim. Now we have Waymo, Tesla, and Zoox. These are the three that are kind of at the forefront of this right now. The reason that Tesla and Zoox don't have any data here is because we don't have any data. When we get any data publicly announced from Tesla or Zoox, Qualtrim will update this data. And the reason that Waymo is flat from Q1 of 2025 to Q2 is that simply the last time they've said or updated the amount of weekly rides. It's certainly gone up. So this is a bit misleading because it's flat, but that's just because we have to put in a number. We're putting in the last number. Once they update us that it's now at 300,000 or whatever landmark they get to, we'll update it with the new quarter. So this shows the progress of this industry over time. What you see is that Waymo's making progress. They went from 10,000 weekly rides up to around 250,000 in just 1 year. Now, I think that Waymo needs to get to around 1.5 million to 3 million per week to make this a profitable endeavor. But this is the start of something really big, and Google has this as part of their business. It's not even important right now. Google doesn't need this money right now, but they're building this up as part of their overall business. In terms of projecting out the future, we can use the DCF calculator here in Qualtrim. It does this very easily. We have the data right here. We can plug in just some different assumptions. If Google grows their earnings per share by 14%, and it trades at a 20 multiple, these are very conservative, I think very low assumptions, you get a 15% return with a 14% earnings per share growth rate and a 20 multiple. Meaning right now, I just think the company's undervalued. I believe that it's an asymmetric bet. There's far more upside than downside. Google investors could lose money, but a lot of things would have to go wrong for a long period of time for that to happen. Next up, we have Meta. And the latest from Meta is that Mark Zuckerberg's basically trying to blitz and buy himself success. He is cold contacting many AI developers, trying to create this super team to get ahead in AI. Now, whether or not that will work is up in the air. I actually think it's bullish for the company. But when I look at the stock, it's now trading above $700 per share. It trades at a 27, almost 28 forward PE ratio, and the free cash flow yield is below 2%, factoring in stock-based comp. If we look at the trailing PE ratio over the past 1 year, it's at one of the higher points. If we zoom out to the past 5 years, it also looks like it's about average, maybe. Not super cheap, not super expensive based on a PE ratio. Now, when we flip over the free cash flow yield, remember that higher is cheaper on this one. Lower is more expensive. Over the past 1 year, the free cash flow yield is about the lowest it's been. Meaning out of this entire year, this is around the lowest point. This is the most expensive. Now, if we look at Meta on the DCF calculator, we can throw in some simple assumptions here. We can assume they're going to grow around 13 or 14% earnings per share growth for the next 5 years. That's around a mid estimate. The company trades at a 26 multiple today. If they were to just keep that, we get a 12.5% return. If the stock gets re-rated just a little bit lower, if it goes down to a 24 PE ratio, then the stock is at an 11% return for the next 5 years. I'm putting Meta in the fair value category. It's good, but it's not great. There's been better times to buy this company. Now, next up, we have Nvidia. Let's go ahead and take a look at this one. It's now trading at 152. So Nvidia has moved up a little bit over the past couple of months. We look at it here. In fact, in the past 3 months, it's up 33%. Year to date, it's up 10%. So it had a nice dip. It's moved back up. Let's go ahead and take a look at this one. It trades at a 31 forward PE ratio. The free cash flow yield is not terrible. It trades at a 1.8% trailing free cash flow yield. Nvidia doesn't have a lot of stock-based comps, so this is undiluted free cash flow. When we look at the historical valuation of this company, we're looking at the price to earnings first. Now, the PE ratio, again, lower is better for this one. We look at it, and right now, it's not terrible. They've been growing earnings so quickly that their PE ratio is not the worst it's ever been. Obviously, it was better to buy it just a couple months ago before this 30% run up. We look over to the free cash flow yield. Higher is cheaper. It's higher now than its historical average. But again, at the same time that the higher free cash flow yield is coming in, the growth is also decelerating. So this isn't the case of it growing the same speed back in 2022 that it is today. Growth is decelerating by quite a bit. Now for Nvidia and the DCF calculator, I'll use the cash flow over the earnings. We'll look at it that way. For the free cash flow per share growth rate, you can throw in a lot of assumptions here. I think that Nvidia is very difficult to estimate what their growth rate is going to be because it's not a subscription company. It's not just recurring revenue. They're selling really expensive devices, but we'll assume a midpoint of 15%. And we'll assume that the free cash flow yield, as the company becomes more mature, as the growth decelerates, that it moves up to a bit higher of a free cash flow yield or a lower free cash flow multiple. We'll assume 2.5%. If we do that, we get a 10% return. So based on these assumptions, which I think are very realistic, we still get a healthy return with Nvidia. I'm going to go ahead and put this one right with Meta in the fair valued category. Now, next up, we have Spotify. This is one of my favorite companies. In fact, I really love the product. I've been a subscriber of Spotify for so long. I should have owned the stock. In fact, I I've been in and out a few times, but let's go ahead and look at Spotify. For this one, I feel like we have to go to dark mode. It just doesn't feel right to look at Spotify in light mode. So we'll go ahead and switch this to dark mode. Now, the numbers with Spotify are a bit shocking. The valuation on a PE ratio, price to earnings, is 68 on a forward PE. Now, on a free cash flow yield, it looks a lot better. It's at a 2%, but it's still expensive. Investors are very excited about this company. They love it. It's up 62% year to date. Just incredible performance, and I love seeing the success of this company. The revenue's growing fast, around 15%. We have the monthly active users ticking up over time. We have all these great KPIs, premium and ad-supported users going up over time. Let's say that Spotify grows super fast for the next 5 years. Let's say a growth rate of 25%. Now, this is 25% every year for the next 5 years. Those are some really healthy, like big assumptions for a company. Then let's say it trades at a multiple of 30, like a premium multiple. When we do that, we get a negative return. Look at this. The stock price goes down from 744 down to 597. We need to buy it at $297 to get a 15% return with these assumptions, with a 25% earnings per share growth rate and a 30 times multiple. So we can bump them up a little bit higher. We can say, let's grow at 30%. Let's have the multiple be at 35. And finally, we're getting a positive return, 2.6% per year, but it's still positive at this time. To get to the point, again, where we get a great return from Spotify, we get into assumptions that I don't love. 40% growth rates, multiples of a 40 PE ratio, that's to get a 14% return. I love the company, but to me, investing is about implied expectations, what you're paying today and the expectations you have of the future. When I look at this, the math just doesn't make sense. Spotify is the type of company that can defy all odds. I could see this one still continuing to do well, but I invest with a margin of safety. I like to buy great companies, which there's a number of, at attractive prices. Right now, Spotify's price is not attractive. Next up, we have Apple. This has been forgotten about a little bit over the past 6 months. Let's go ahead and take a look at Apple. Apple's still above $200 per share. What a resilient company. It's difficult to ever bet against Apple. But if we look at the company today, and we look at some of the valuation metrics, we can zoom in here. It trades at a 28 forward PE ratio and a free cash flow yield of 2.7, 2.8. These aren't bad ratios in and of themselves. The free cash flow yield especially is not too bad. Now, when we look at Apple, the troubling thing about these numbers are that this is a company that's basically, as of right now, not growing. If we look at the past 5 years, Apple grew their revenue 5% over the past year. So it's growing just above inflation. The past 2 years, it grew 2% growth rate. So it's a company that's really stagnant at this point in time. On a net income basis, it looks the same. The net income's the same year over year. The free cash flow is the same year over year. Even as they're shoveling money into buybacks, they're not able to grow their free cash flow per share. Qualitatively, there's a couple things I don't like that's happened with Apple. One of them is that the product that they did get out was the Apple Vision Pro headset, which I didn't even buy, and I'm an Apple fanboy. I buy most of the things they sell, but that didn't interest me. And it also wasn't a huge success. It's not a product you see people using. Meanwhile, they gave up on the Apple Car, something that Google is able to figure it out. Why was Google able to figure out Waymo and the self-driving car, but Apple, the hardware, software integrated company, couldn't figure that out? So that's also troubling that Apple gave up on that project, which I think had a lot more potential. What I see with Apple is a company that's moving into the cash generative type of company. And that's a fine place to be, but it's not the most intriguing story. When we look at the PE ratio, Apple is getting cheaper year to date. So it started off with a 38 trailing PE. Now it's down to a 32. But if we zoom out a bit, over the past 5 years, Apple has been cheaper anytime below this line. So there's been many times where Apple is a cheaper company than it is today. In fact, today it still remains at an elevated historical valuation. So even if we assume growth of, let's say, 10%, which would be an acceleration because growth has slowed down so much, we assume a nice healthy multiple of a 27, that's a 6.7% return. With these assumptions, even if they somehow grow 15% for the next 5 years with the same multiple, they're at an 11-12% return. I would put Apple in the overvalued territory, but for me, this one still remains a sell. And the reason why is not because Apple is a bad company. It's a fantastic company, but it's moved away from the quality growth bucket into more of a mature, slower growing, cash flow generative company. It's moved into more of like a consumer defensive, a company that really just pays a dividend, it grows a little bit slower, and it doesn't have that market-beating return potential that other companies have. So as of right now, I have it in the sell category. I'll let you know if I move it out of that back into a buy. Now, next up, we have Mastercard and Visa. I'm just going to bucket these together. So we'll go ahead and look at Mastercard. This is the one I own, but my comments can cross over to Visa very easily. They're both very similar, lots of overlap. When we look at why Mastercard is down a little bit over the past week, it's because of this stablecoin news. I'm sure you've heard it, where the government is now embracing stablecoin. For crypto, one of the biggest challenges was government regulatory oversight. That was one of the things that slowed down the progress of crypto. And now with the government embracing crypto, investors are looking more skeptically at Mastercard. But I believe that they're incorrectly looking at this. I think that Mastercard and Visa are far more prepared to deal with stablecoin and even profit from it than what people believe. When we look at this, a couple things to point out here. Mastercard is around half their payment network and half value-added services, roughly. It is a massive part of their business. Value-added services are things like security, fraud detection, all these different services like consulting with different companies, helping settle different transactions. They have such a massive network that they can leverage that to offer a ton of different types of services oriented around that network. And stablecoins can benefit from that. In fact, Visa and MasterCard have both publicly said that they're not sheltering in, they're not concerned about stablecoins. They are embracing them and offering a host of services, integrating them into their network as well. They're going to be able to settle different transactions and help embrace crypto and stablecoins. Now, outside of the qualitative stuff, if we look at the valuation of this company, on the ratios, it trades at a premium valuation, but MasterCard almost always does. Visa and these companies are extraordinarily high quality, so they trade above a 30 PE ratio. On a cash flow basis, they always look a bit cheaper. So the way that they expense things, it just makes cash flows look a bit better. But I actually like looking at these companies in terms of free cash flow. I think it's better. It's been a better way to assess these companies historically. When we look at the free cash flow per share growth and just look at how astounding that is. Over the past 5 years, it's grown at 16%. I assume that growth is going to be somewhere around 15%. That's the hurdle I look at for MasterCard. And I believe that the company will trade at around a 3% free cash flow yield, somewhere around that. And so I'm pulling forward a lot of what's already happened. I think the stock's going to return around 15% per year for the next 5 years. In my opinion, Mastercard is a good bet today. With the recent dip in this company, I think it's an opportunity for investors. I'm going to put this one in undervalued because I believe it's just a matter of time till it gets back to all-time highs. I think the stablecoin, any dip you get from stablecoin news is going to be a gift to Mastercard or Visa investors. Now, next we have Amazon. This is one of the ones that I have to admit, I'm excited about Amazon. I just love this company. Amazon is a very unique company that even at a $2.3 trillion scale, they're still in startup mode. It's still day one for Amazon. They're always inventing, reinventing, reinvesting, building, and developing in new verticals, creating more operating cash flow, and they're building and building and building an assortment of incredible businesses brought together under a same umbrella. And it's a company that can leverage all these different businesses together in a way that I don't even think Berkshire can. So Amazon can do different things like leverage their AWS with their retail market space, with their robotics, with their AI. They can implement and cross-sell and cross-implement all their different technologies in a way that a other conglomerate can't really do. The price to earnings has actually come down over the past year, from in the 50s trailing now to 35. Valuation is tough on Amazon. There's a couple different things we could look at. For example, we could put in that we think the earnings per share are going to grow at like 25% per year. We think it's going to trade at somewhere around a 33 multiple. You get a 23% return if you do that. Some people may say that this is a very lofty assumption. We could take it down to a 20% growth rate. Still, we get an 18% return, and so on. I personally think that Amazon's going to grow their earnings very quickly. And I believe that Amazon is a buy today. I think the company's undervalued. In my opinion, this one is headed to 260. I think it's just a matter of time. Next up, we have MSCI. This is an indice business for the non-US indices. They basically cover a lot of things that S&P Global don't cover. You have S&P Global, which owns the Dow Jones, which is like the S&P 500. And then you have MSCI, which has the world indices. So this one is a really big company, which has a huge network effect. It's just one of those companies where the more the ETFs and different things linked to their indices, the more and more people use it. So it has an incredibly powerful moat. You have to understand that looking at the valuation metrics, because you're evaluating a company here that's very much like a Mastercard or Visa. It's just a very, very moaty company. When we look at the valuation over time, MSCI is also a company that's trading at a lower valuation than it historically has over the past 5 years. Not many time periods where it's been cheaper than today. When we go to the free cash flow yield, again, it's just the reversed. It's almost at the cheapest point it's been in the past 5 years based on a free cash flow yield. Right now, if you're buying into MSCI, it's like you've been waiting patiently for one of the cheapest points to buy into it. So if I look at it today based historically, it looks like a deal. Running future assumptions, we can use the cash flow on this one. I think that would be more appropriate. We can assume it's going to grow around 16% free cash flow per share growth over the next 5 years. Over the past 5, it grew at 18%. So we're assuming a slowdown here. If we assume it trades at a 3% yield, that's an 18% return. To me, this one's a buy. I think we have a lot of ones that I'm rating as undervalued here, but I just think it's accurate. These are wonderful companies, and in the case of MSCI, it's trading at a 5-year low valuation. I think future expected returns will be rather good. Next up, we have Uber. These are such good companies. We're going over a lot of great companies. Uber has been a fantastic bet. It's really paid off for investors that have been buying this one in the 70s and the 80s. I said that Uber had a 90% chance of being a great investment, and I still stand by that. I think over the next 5-10 years, you still have 9 out of 10 odds of this being a great investment, which I think is really good odds. So it's worth betting on. Uber has, however, moved up a lot year to date. It's up 43%. So the stock price continues to go up faster than the fundamentals are growing at this point. Now the valuation, it's trading at a 32 PE ratio. When we look at Uber, a couple things that I want to point out. We just had Robotaxi, Tesla's Robotaxi launch. We have Waymo doing 250,000 rides per week. And a lot of times you can look at that and get concerned about Uber. What does this mean in 5 to 10 years? Well, that's true, but Uber has a lot of time to figure this out. If we look at just the numbers, Tesla's Robotaxis right now, there are around 30 of them. So there's 30 of them in a very confined area, trying to test things out and figure it out. They're kind of testing it on the fly. They have someone in the passenger seat that has a button they can stop the rides, right? But that's 30 vehicles driving around in a very confined area. They're doing thousands of trips per week, maybe 1,000 trips per week. We look at Uber, the trips that they did over the trailing 12 months is 11.74 billion with a B. Almost 12 billion with a B. The numbers are so different. They're not even in the same stratosphere with each other. So Tesla and Waymo have to grow orders and orders of magnitude just to get anywhere close to where Uber is today. And over that time period of them growing and expanding and scaling, even if that happens quickly in terms of robotaxis, Uber has time to combine and network with different companies to integrate into different services, and they have time to adjust. So Uber, even though it's a difficult situation with autonomous vehicles, they're still well positioned to figure this out over the next coming years. If we look at it growing maybe 14% over the next 5 years, the company trading at a 4% free cash flow yield, you get a 15% return. So I think moderate return from here forward. The company has had most of the excessive growth behind it, but I still see Uber continuing to grow and raise margins over time. With Uber, that risk is still always going to be priced in the stock of the AVs. For the past couple of months, I've had Uber as undervalued. Today, I'm going to put it as fair valued. Just because the stock price has gone up so much, the growth is decelerating a bit, and I think the company is more appropriately priced today than it was 3 or 4 months ago. Next up, we have ASML. This is one that's in my portfolio. I'm very bullish on it, and even though the stock has been moving up nicely, year to date, the stock's up 16%. You can see that it's gone up a lot over the past 3 months. I was pounding the table on this one when it was $700, $600, saying that I think it's worth $1,100. Well, my thoughts on the company hasn't changed. Even though it's traded up to $810, I still think this one is undervalued, and I'll tell you why. It trades at a 34 PE ratio, 3 to 4% free cash flow yield. The company's growing its revenues, it's growing its cash flows. They're building out these machines that are incredibly valuable. Yes, there's potential competitors, China is working hard to build out their own chip infrastructure, including lithography. But I think that even if China does, it's not the end of ASML. This company will continue to be a massive supplier of this important technology. So I see it as just a continued growth story of something that's incredibly important. You can see the lithography system sold over time. They're selling more and more of these devices over time on a trailing basis, and the devices themselves are getting far more expensive. The newest ones are like $400 million a device. So incredible to see the growth. The EBITDA is growing. The free cash flow is growing. They have lumpy free cash flows because they accumulate all the cash at once. They'll basically bill everyone and say, hey, you have to pay us this quarter. But over time, if you smooth this out, they're growing their free cash flow like 20% per year. On a historical basis, if we look at the PE ratio over the past 5 years, it's one of the lowest points it's been. So it's one of the cheapest points the past 5 years. We look at the free cash flow yields, it shows the same thing. It's one of the cheaper points this company has been over the past 5 years, but I look at this more at price to earnings. The company, I believe today, is relatively cheap on a historical basis. If we look at some assumptions here, I think they can grow their earnings per share by 20%. I think that the multiple this company will trade at is in the mid 30s. And we're going to have around a 15 to 20% return per year. I can do the same thing with the free cash flow. These are healthy assumptions, in my opinion. Unless something super dramatic happens to ASML, this company is a good bet. For me, ASML is still in the undervalued category. I think this one's a buy today. Now, next up, we have a tricky one, which is Adobe. When I look at Adobe, there's a couple different considerations. There's the quantitative side, which is just the numbers. And Adobe looks cheap just by the numbers. The PE ratio is an 18 PE. The free cash flow yield is a 4.6% free cash flow yield. So it's cheap on a PE ratio, it's cheap on a free cash flow yield. If we go to the valuation over time, you'll see a similar picture being painted here. The price to earnings over the past 5 years, it's at the cheapest point it's ever been. The free cash flow yield over the past 5 years, it's at the cheapest point it's ever been. So investors are becoming less bullish on Adobe. They're just selling out of the company. And there is some reason behind that. Adobe right now looks good in terms of the fundamentals. Again, if you look at just the quantitative stuff, the numbers, the growth rates, all of that stuff, it looks like things are going fine. But the big question for Adobe is the industry that it operates in and some dramatic changes that are happening to that industry. Adobe is a creative media company. They have the Adobe Cloud Suite, which is where they get most of their revenue. And in that, they have video editing and photo editing. This is technology that's rapidly changing every month. There's AI photo editors, there's video editors, there's Google coming out with a VO3 that can make videos on the fly. There's so many tools doing this now that when I look at Adobe, even though they have these long-term relationships, they already have so many customers using them, for me, it's a very troubling story to get behind. I just can't get behind the story. No matter how much we look at the valuation, I have to first get behind the narrative that things will improve over the next 5 years and 10 years. The AI won't cloud out more of this business. I feel like Adobe is getting attacked on every front. There's so many other photo editing tools and video editors. AI is getting stronger by the day. And so for me, it's very unsettling to think about owning a company like Adobe. Adobe belongs in one of two categories. Either it's super undervalued and it's going to like double or triple over the next couple of years. Investors that were concerned about it will miss out, and that's fine. Or Adobe's a value trap, and it's a company that is trading at a low valuation, pouring money into buybacks, but it's trying to just ignore the inevitable, which is that its moat is getting smaller by the day. In my opinion, it's just too difficult to figure out. So whether or not this company's truly undervalued or a value trap, I'm not going to figure it out. In my opinion, it's an avoid. It's a sell. I think there's clearer companies that are less troubled, ones that have great opportunities for growth and value without such big risks facing the company. Next, we have Intuit. This has been a core position in my portfolio. I personally think it's a wonderful company. It's often overlooked by retail investors because of the vertical that it's in, which is accounting software for small businesses and tax software, and then Credit Karma. Boring, boring, and boring. But They have a dominant market share, and these are mission critical products. You can't go a year without doing your taxes. You'll start getting in trouble. That'll catch up to you. You also can't be a small business and decide to not just file your quarterly taxes. So their products are mission critical. They have to be done every single year. Basically, all their revenue is recurring. It's growing really fast as well. 15% revenue growth year over year. It's spiking. The revenue is just going up like crazy. On top of that, with the growth, they're showing true operating leverage due to artificial intelligence, meaning that their employee count is going down. For example, if we look at the free cash flow and stock-based comp, the stock-based comp is leveling out, the employee count is going down, and the free cash flow is surging while the revenue is growing. Everything is moving in the right direction at a fast pace. And management is reiterating that this isn't by some mistake. This is all planned. They're using artificial intelligence to make their entire company inside and out run better. They're also enhancing all of their products. They talk nonstop about artificial intelligence. Just incredibly powerful, growing super fast. The problem with Intuit is that it's just expensive right now. There's no way around it. If we look at the PE ratio, it's one of the higher points that it's been over the past 5 years. If we look at the free cash flow yield, it's not the lowest it's been. It's not the most expensive, but it's at one of the lower points. Investors buying it today are certainly not buying a dip in the company. Even with good multiples, good assumptions of growth, this company gives a subpar return. Intuit's in the overvalued territory. For me right now, it's just a hold. Next up, we have Equifax. This is a company that I become more excited about the more I study it. Equifax is becoming a data company, specifically a know your customer company, know your employee company, a verification company of someone's entire work history and their identification. We live in a time where people lie about everything. They lie, there's so much fraud about who they are, where they've worked, what they made at different companies, how long they worked there, what positions they held, if they can pay back a loan, if they can't, and so on and so forth. So a company that can credibly and efficiently and legally verify someone's history is an incredibly valuable product. And Equifax is positioning itself as a very unique vendor for this product. It's the only one that's able to do it. They're the only one with this data set. It's very difficult to recreate. I believe there's a lot of catalysts that are going to change this company over the upcoming year. An increase in the amount of mortgage demand as interest rates go lower. They're transitioning from doing their cloud-based transformation. This has re-transformed the company into a tech and data company. They have more unique data right now and a huge network effect. They're pushing out more products. They've really turned around a lot of things. And I think it's very unlikely for them to have another data breach like they did before. So when we look at this company, I have pretty lofty assumptions for it. I think it's going to grow quickly in the future. I think we're going to see free cash flow growth of around 15 to 20% per year. With a 2.3% free cash flow yield, we get a 19% return. Now, these are pretty aggressive assumptions, but I'm very bullish on the outlook of this company. This is one that I'm actively buying right now. I put it in the undervalued category. We'll see what happens over the upcoming earnings reports over the next year or two, but I'm excited about this one. Next, we have Netflix, which is obviously a massive core position of mine. It's probably my most significant bet in terms of the volatility of the company, how much people really discouraged me from buying Netflix. It was one of the ones that was one of the most antagonistic stocks, I would say, in my history. But Netflix has been on a roll. It's now moving up to $1,300 per share. This is an all-time high. I can't go on enough about how excited I am about this company. I really think they just have such a bright future. I continue to believe that. The valuation, however, is getting a little bit in the higher territory. It now trades at a 48 forward PE ratio, free cash flow yield of 1.4. So now, word is out. Netflix is a great company. More and more people are believing that narrative, and the price is reflecting that. There's obviously been a lot of better times to buy Netflix than there is today. In the past year, the PE ratio has only gone up. Now, in terms of the DCF, I'm very bullish on their ability to have operating leverage and grow free cash flow per share. I think they can grow it above 20% over the next 5 years. I'd say like 22%. If we have a 1.5% free cash flow yield, that gives us a 19% return. If we have a more conservative estimate, a 2% free cash flow yield goes down to 13%. If we say that it's going to go back up to a 3% free cash flow yield, we only get a 4% return. Right now, I think Netflix is a great hold, but I'd look for better times to enter in. I think there's more attractive entry points for this company. In my opinion, it's fairly valued. Next, we have Tesla. Let's go ahead and take a look at some of the valuation metrics here. Tesla's still at $325. Now, I've had the opinion that Tesla has been overvalued for a very, very long time, all the way since 2021. I owned Tesla stock in 2020. I sold it in 2021. I had 100% returns with just a $1,000 position. Ever since then, I thought that investors were pricing in too much too quickly. Now, the stock has traded flat for around 4.5 years. So we're going on a long period of time of awaiting for the fundamentals to catch back up to the share price. It looks like it's getting closer to that point, but I still think it has a ways to go. The issue I have with Tesla is how big the expectations are. It's a $1 trillion company doing around $6 billion in free cash flow. They have a lot of different variables and moving parts. Car companies are very difficult. They're losing different tax incentives and that type of thing, but they're also growing a robo-taxi business. There's a lot going on with this company. But even if we assume 15% growth and a multiple of a 35 multiple, very healthy multiple, we have horrible returns. We can assume 30% earnings per share growth and a 35 multiple. And we have horrible losses, 6% loss per year. We have 60% earnings per share growth and a 35 multiple. Then we finally get to 15% returns. Do you see the problem here? We have to assume 60% earnings per share growth every year compounded for 5 consecutive years just to pull together a 15% return. So when I look at Tesla, I think it's a great company. I really do. I think that Tesla is a very unique company ran by Elon Musk. They have a lot of will. They have a lot of capital. There's a concentration of talent. I understand that, but we're ranking investments against each other and the relative opportunity. I believe the same issue that Tesla investors faced back in 2021. So right now I consider this one overvalued. Now, next up we have Palantir. Palantir is an interesting one because the stock continues to go up no matter really what happens. The market cap is now $320 billion. It's priced as a massive company, but it's just doing over $1 billion in free cash flow over the trailing year. The PE ratio on a trailing basis is 587. On a forward basis, it's 232. They basically are pricing in that the company will double in size and double in size again and double in size again. It's like 3 consecutive doubles is what this company needs to do. So maybe it can do that. But when I look at investing, I'm weighing different bets and if I think that they're going to be predictably good bets. If we look at Palantir from a discounted cash flow calculator, the earnings per share make it look really bad, but that's because Palantir has very low earnings per share right now. So I won't use that. I'll use the free cash flow, which I think it does portray Palantir in a better way. If we look at the free cash flow per share growth, if we assume 30% free cash flow per share growth over the next 5 years, and we have a very low multiple of 2%, meaning we're pricing this company highly, we still get a negative return, minus 6% per year. So we can try to price it at like a 1.5% free cash flow yield. Then we're getting flattish returns. Maybe it will grow 40% per year. Then we get positive 7% returns per year. Even if it grew free cash flow per share by 40% and it still traded at a healthy 1.5% yield. In my opinion, this could happen, but it's very, very challenging. There's so much that can go wrong with this thesis. Any large deceleration, any competitive force, anything that doesn't work out could cause this one to be disastrous. And given the fact that it trades at such a premium, that people are willing to pay so much, if I own this stock and I wrote it up to the price it is today, I'd probably take the gains and deploy it elsewhere. That's what I'd be doing. I personally would take some gains off the table. Next up, we have the yoga pants company, Lululemon. This one is showing up on a lot of people's lists because if you're a value investor, you're looking for companies that are selling off, trading at the lower valuations. And we have Lululemon here, which is getting utterly decimated this year. Year to date, down 38%. Investors are concerned that there's other competitors eating the Lululemon moat. And I share those concerns. When I look at Lululemon's valuations, they look attractive, but again, we don't want to be buying value traps. That's something that we want to avoid. In some cases, you'll get it wrong, where you avoid a company and the stock will go up. It'll look like it wasn't a value trap. But I don't believe it's good to buy into a lot of low valuation companies that have fundamentals going in the wrong direction. In the case of Lululemon, it trades at a 15 PE, a 4.6% free cash flow yield. It's one of the cheapest by the numbers that we've seen. But that doesn't illustrate the full story. The full story with Lululemon is that their moat of these nicely made yoga pants, these workout pants, there's lots of companies doing the same thing. There's yoga companies doing the same thing. There's companies like Viore making slight alternatives. There's even Costco with the Kirkland Signature alternatives that are pretty close doing the same thing. And the list goes on. These other companies have also gained large market share. So what Lululemon used to have, which was ownership of this category, this premium ownership over it, now they're sharing it amongst a bunch of different competitors. And this is why I've been saying that brand value in and of itself, I don't believe is the strongest moat. I think you have to have switching costs, embeddedness, network effects, other aspects of a moat. In my opinion, just brand value alone is very tricky. Lululemon is in the sell category. It might surge up. You may look back and say, hey, it's double or triple the price of this video. That can always happen, but there's also the chance that this one just goes along as a value trap for year after year. And for me, it's too difficult. There are easier bets, more predictable in the market that are also trading at great valuations. Next, we're looking at AMD. AMD is an interesting company. It has a large social media following, lots of people excited about this company. I think it's very similar to Nvidia. Nvidia is far more dominant, but AMD has carved out as this second place to the leader, and I think they're in a good position. Now, the valuation, it trades at a 35-4 PE ratio, 1% free cash flow yield. They have a lot of stock-based comp right now, but the free cash flow is back on the upswing, and it's likely going to go higher. On a free cash flow yield basis, it's not the cheapest it's ever been, but it is on the low end. In fact, it's cheaper than it has been over the past year. When I look at a DCF for this company, I can assume around 20%, maybe 25% free cash flow per share growth over the next 5 years. I think that's rather aggressive. If we look at it on a 2% free cash flow yield, so the valuation comes down a little bit, but the growth rate remains very strong, we get a 13% return. AMD is fairly valued. I don't think it's at an extreme deal today. Like a lot of other investors, I think that there is some upside in the stock. It will likely have a healthy return, but I believe there's better options in terms of pure valuation. Next up, we have Costco. This is another significant winner in the portfolio, a core position. It's really grown into it. I love Costco. I think it's the best company in the world. I say that non-ironically. It's just so good, all things considered. But this stock is expensive. There's no way around it. It trades at a 54 PE ratio, 1.5% free cash flow yield. We can plug in different assumptions that it will grow its earnings per share at 16, 17%. Let's go ahead and go with that. That it will trade at a 35 PE, and we get 7% returns. So I think Costco will have positive returns, but you still have to have healthy assumption to even get these positive returns. It's not Palantir levels of overvalued. It's not one that I feel like is so egregious that I have to sell it today, but I certainly think that there's better times to buy Costco. Right now, I put it down in the overvalued category. Better times to buy this company, even as good as it is. Next up, we have Booking Holdings. Booking.yeah, the vacation company. I use the app. I think it works well. And a lot of people, they think that AI is going to take over booking vacations. I think artificial intelligence helps you plan vacations, maybe like create a packing checklist, fun stuff like that, maybe come up with ideas of what to do where you travel. But in terms of actually booking it, people want structure. They want an application that's built just for that they can transact just through that they can look at photos and it has reviews and it has all the infrastructure, that it has customer service. I think it's going to be much more difficult to actually replace what Booking Holdings is doing than what a lot of AI entrepreneurs are believing. So I think the moat is intact for Booking. When I look at the valuation, we're back at the $5,500 share price. Now, this has gone up a lot in the past couple months. Past 3 months, it's up 14%. Year to date, it's up 10%. Booking is one of these companies that is insanely high margins, insanely profitable. They do so much in the way of buybacks and return of capital. Check out this return of capital chart. They returned $8 billion back to the shareholder. Just incredible. They're paying dividends. They're doing buybacks. They eat their share count every single day. It's pretty crazy. Right now, not the best time to buy the company. Could have bought it cheaper virtually any other time this year. We look at the free cash flow yield and it shows the same thing. It's one of the lowest free cash flow yield points of the year. That doesn't necessarily mean that it's overvalued today, but it does mean that there was better opportunities virtually any other time. I think Booking Holdings will continue to grow relatively fast, around 18% If they trade at a 30 multiple, if the multiple comes down a little bit, we still have a 15% return. Now we take more conservative estimates. We can say the growth is going to decelerate to around 15. We get a 12% return there. I think that this is accurately going to be the case with Booking Holdings, but I do believe it's fair valued. I think it's going to have an attractive return. And there you have it. We have 20 companies, very popular stocks, and their relative valuations. There's no guarantees with any of this. This is just my current thoughts and sentiment on these companies. If you like this type of content, make sure you subscribe to the channel. I'll try to do these type of videos once every 3 months. That's going to be it for now. See you in the next one.